Silver didn't just cross $100. It broke the ceiling that kept this market predictable. For decades, $100 wasn't just a number. It was psychological containment, the point where rallies stalled, doubt returned, and investors hesitated. Now that barrier is gone, and the market is in price discovery. No historical resistance, no proven ceiling, no familiar roadmap. Silver has already traded above $115, and that matters for one reason. Because once triple digits become normal, the old strategy dies overnight. But here's the part nobody is saying out loud. The higher silver goes, the easier it becomes to go higher. In most markets, rising prices reduce demand. In this one, the opposite happens. Triple digits act like a signal flare. Momentum replaces patience, headlines replace logic, and hesitation becomes expensive. If you're still waiting for a clean dip back to $90, you may not get it. Not because dips can't happen, but because the new support is forming faster than people can react. Now watch how fast this escalates. The world sees silver at $100 and assumes this is the top. That assumption is exactly what makes the next phase so dangerous. Because the real story isn't the price, it's the speed, and the fact that the market's behavior has changed underneath you. The breakout didn't happen in slow motion. It compressed time. Moves that used to take months are now happening in days. The climb from 20 to 30 once required patience. Now the market can run $10 in a week and make it feel normal. And once the crowd accepts that kind of volatility, the entire rhythm of decision-making changes. This is where the pattern becomes visible. Silver is no longer trading like a value metal that grinds upward quietly. It's trading like a momentum asset that punishes hesitation. It's pulling in new money, new headlines, and a new class of buyers who don't care about fundamentals. They care about not being left behind. Here's why that detail changes everything. In a momentum market, the correction you're waiting for becomes the correction you never get. So the real question isn't, will silver dip? It's if it does dip, who gets to buy it first? The strongest claim you can make right now is simple. This is no longer a normal bull market. It's a time-compressed melt-up, and the price action is telling you the window is closing faster than most investors can process. Look at what the data implies. Early in this cycle, silver needed months to push through small ranges. Now, it can leap across psychological levels in days, sometimes in a single burst. That kind of acceleration doesn't come from careful accumulation. It comes from liquidity gaps. Moments where demand overwhelms available supply and price has to jump upward just to find the next seller. But notice what's missing. There's no gentle retest behavior here. No long pause at the old ceiling. No extended hesitation. The market cleared $100 and kept moving, as if the resistance was never real. Just a story people believed until they stopped believing it. And once belief breaks, behavior changes. Wait and see becomes act or miss it. A plan built for weekly charts becomes useless in a market that can reprice your entry point overnight. Now, watch how fast this escalates. When a $10 move feels normal, $50 stops feeling impossible. Once silver clears $100, the next danger isn't only the price, it's what the price does to the system around it. Because every step higher forces the entire physical market to adjust. Dealers, refiners, premiums, inventory, even what counts as sellable metal. In a normal environment, supply flows smoothly. Old silver gets melted, recycled, and turned back into fresh bars and rounds. But in this environment, the machinery starts jamming. Refiners slow down. Payment timelines stretch. Middlemen protect their cash. And suddenly, not all silver is treated equally anymore. This is where the story flips. A bifurcated market forms. One lane stays liquid, the other turns sticky. Pure .999 bullion remains the preferred product because it moves cleanly through the pipeline. But alloyed silver, sterling, 90% coin silver, starts behaving like a problem asset, not because it has less metal value, but because it has more friction, more processing, more delay, more risk for the buyer trying to flip it fast. And notice what this really means. Your exit isn't defined by spot price. It's defined by who is willing to take your metal today, at speed, with cash. Once that truth hits the market, liquidity becomes the real premium. Here's the more disturbing proof. The physical market is already showing signs of a liquidity trap, and most investors won't notice until they try to sell. In this environment, refiners aren't behaving like eager buyers. They're behaving like gatekeepers. Reports indicate they've effectively stopped purchasing certain types of secondary silver entirely, especially 90% junk silver and sterling, while others will only take it with delays ranging from 10 days to as long as 3 months. That is not a minor inconvenience. That is a structural warning. Because dealers don't operate on theory, they operate on cash velocity. They buy inventory, move it quickly, get paid, and repeat. The moment refiners slow down or refuse certain product, dealers become reluctant to absorb it, no matter how high the melt value is. Notice the contradiction. The spot price can scream profit, while the real-world pipeline quietly says illiquid. You can be up massively on paper, but trapped in practice. And that's the kind of trap that only shows itself at the exact moment everyone tries to exit together. This is where your strategy has to get smarter than the crowd. Not all silver is equal in a stress environment. The metal you can move fast becomes more valuable than the metal you have to explain. And once liquidity becomes scarce, the rules change permanently. Now zoom out and watch the signal that almost nobody prices incorrectly: sovereign behavior. Because when governments start repricing metal, they're not reacting like retail buyers. They're projecting what they believe the next reality will be. One of the clearest indicators is how official channels have begun setting prices that look absurd relative to spot. Proof-grade silver products have been repriced to levels that imply a much higher sustained market, well above what casual investors think is fair. This isn't about production costs. It's about refusing to be caught chasing a rising market from behind. Here's why that detail changes everything. When a sovereign issuer prices silver like it expects higher levels to persist, it quietly tells you the current range isn't treated as a peak. It's treated as a base, a new floor. And that creates a split-screen reality for buyers. One side of the market is still anchored to the screen price, spot plus a reasonable premium. The other side is anchoring to what official institutions are charging, which effectively normalizes much higher valuations. That gap matters because it changes how people behave. It makes the official price feel like the future, and today's spot feel like the past. And once the crown starts using future pricing as the reference point, the rush accelerates. This is how bull markets stop climbing and start pulling. At this point, silver isn't just a metal. It's becoming a social phenomenon. And that's where the market enters its most unstable phase, retail mania. A new class of buyers is showing up, not because they understand supply chains or ratios, but because they can feel the dollar weakening, and they can see the number on the screen rising. They're buying first and learning later. And when that happens, silver stops behaving like a normal commodity and starts behaving like something else entirely. A Veblen-style asset, where the rising price doesn't reduce demand. It creates demand. Now watch how fast this escalates. Dealers can bring in massive inventory, and it still disappears almost instantly. Showcases look full for a moment, then empty again. Scarcity becomes visible. And once scarcity becomes visible, the purchase turns emotional. People aren't buying because it's cheap. They're buying because they're afraid they won't get any at all. But here's the part nobody is saying out loud. Mania doesn't just lift price. It distorts behavior. It pushes people into panic buying during spikes, paying premiums they would never accept in a calmer market. It forces decisions at the worst possible time, when spread is widest and emotions are highest. The smart move isn't to outrun the crowd. It's to stop moving like the crowd. In this phase, relationships, timing, and discipline matter more than any chart pattern. The next shift is quieter, but more important than retail mania: institutional capitulation. Because when the professionals stop fighting the move, the entire downside structure collapses. For years, the story around silver was built on one assumption: that powerful players could always lean on the price, create violent smashes, and scare the market back into submission. But now, the behavior has changed. The short side is impressing. In fact, the short trade is becoming something nobody wants to touch. Even with availability to borrow, the appetite to bet against this move has evaporated. And that matters because price suppression only works when someone is willing to take the other side. Notice what this really implies. The old cycle relied on fear-driven flushes, those sudden drops that trained investors to wait for the inevitable crash before buying. But when institutions either step away or reposition, those flushes lose power. The dips become shorter, and the recoveries become faster. This is where the story flips. The market stops behaving like it's controlled from above and starts behaving like it's starved from below. When sellers disappear, upside volatility becomes unchecked. It's not that silver can't fall. It's that the fall no longer resets the market. It reloads it. So if you're still waiting for a smash to give you a perfect entry, you might be waiting for a mechanism that no longer functions. And in a market where the old brakes are gone, momentum becomes the only law left. Now the story stops being just financial and becomes geopolitical. Because in this cycle, risk isn't a headline that fades in 3 days. It's becoming a permanent bid under the market. The world is operating with continuous instability, conflict pressure, military posturing, and strategic moves that signal something deeper than diplomacy. When the system becomes unpredictable, capital seeks insurance. And precious metals don't need perfection to rise, only uncertainty. The moment investors accept that the peace era is gone, they stop treating metal as a trade and start treating it as a necessity. But here's why that detail changes everything. Geopolitical risk doesn't reprice gradually. It reprices instantly. One flashpoint can shift the market overnight, turning yesterday's expensive level into tomorrow's baseline. And that's why short-term lulls don't matter as much as people think. Calm isn't stability. It's just the pause between shocks. This is where the silver mindset changes for the viewer. It's not only about return. It's about resilience, about owning something that doesn't depend on any institution staying rational, any currency staying credible, or any conflict staying contained. And once investors start thinking like that, they don't sell on mild relief rallies. They hold through them. They buy through them. Because the fear premium becomes part of the price's DNA. So when people ask, what happens if things cool down? The better question is, what happens if they don't? Here's the systemic twist most people miss. The real silver price might not be the one you're watching, because price discovery is starting to shift east, and the arbitrage is doing the pulling. A premium has opened up in Asian markets, with Chinese pricing running noticeably higher than Western spot. That spread isn't just trivia, it's a vacuum. If silver is worth more on one side of the world, physical metal will migrate there. Inventory moves, vaults drain, and Western prices are forced to follow. Not because analysts change their forecasts, but because supply gets pulled out from under them. But here's the part nobody is saying out loud. The screen price can become a lagging indicator. It can look calm, while the real-world flow is aggressive. If the premium stays wide, any dip in Western markets becomes free money for arbitrage. Buy here, ship there, capture the spread. And that means your pullback doesn't stay on the screen for long. It gets bought instantly, swallowed by the pipeline before retail even notices it happened. This is where the story flips into a global contest over real assets. If one region is willing to pay more, the entire world inherits that valuation. Western spot doesn't get to stay cheap out of principle. It only stays cheap if physical supply is abundant. And right now, the incentives are pointing the other way. So the next time you see a dip and think, finally, relief, ask yourself something sharper. Relief for who? At this stage, smart investors stop thinking in raw price and start thinking in ratios, because that's how you measure power inside a metal cycle. And the key ratio is already moving fast: gold versus silver. Silver is outperforming gold hard enough that the gold-silver ratio has compressed below 50-1. That's not just a statistic. It's a signal that silver has moved from catch-up trade to dominant momentum. When that ratio falls, silver isn't rising quietly. It's forcing gold to look slow. But here's why that detail changes everything. Silver's strength is also its danger. It's the higher volatility metal, which means the same force that creates outsized gains can also create violent shakeouts later. And that's why serious players don't just ride silver up. They plan the rotation. The highest level strategy in a cycle like this is staggered conversion, taking portions of silver gains and locking them into gold as the ratio compresses further. Not because silver can't go higher, but because gold acts like a volatility sink. You capture the explosive upside in silver, then secure it in a metal that holds value with less chaos. Notice what this prevents. It stops you from becoming rich on paper and poor in execution. It gives you a way to convert momentum into stability, while the crowd is still hypnotized by the next price target. And once the ratio gets extreme, the smartest move won't be buying more silver. It'll be deciding what you want your wealth to look like on the other side of the cycle. Now let's move into the leverage layer, the place where cycles turn into fortunes fast and destroy people even faster. Mining equities. Because when metal prices break into a new regime, the stocks don't just follow. They often overshoot. Capital is already flowing in. Financing is getting done aggressively. And deals are closing without the old sweeteners that used to be required just to attract attention. That's a sign of institutional urgency. Money doesn't negotiate when it believes time is running out. And in a silver melt-up environment, miners become the narrative's amplifier. They offer exposure to the upside with more torque than physical metal, but with more fragility too. But here's the part nobody is saying out loud. Not all mining companies are silver exposure. Many are marketing machines disguised as investments. The winners in this phase are the ones with scale, grade, and credibility, teams that can prove a real deposit, expand it, and survive the market's impatience. This is where selectivity becomes your edge. District-scale exploration, high-grade potential, and teams that can map structure, not hype, become the true lottery tickets. The modern playbook isn't about luck. It's about finding what the last cycle's capital starved and what the majors now need to replace. And the exit isn't wait forever. The exit is M&A. When majors can't find enough metal organically, they buy it. That's how juniors turn into takeovers. And that's why this isn't just a metal story anymore. It's a reserve replacement war playing out in public markets. Here's the final layer that turns this from investment story into system story. Friction. Taxes, jurisdictional rules, and liquidity constraints are starting to shape behavior as much as the price itself. Some places are making physical accumulation harder through punitive taxes, forcing buyers to change geography just to protect purchasing power. And once people start driving hours to transact, once they start designing purchases around avoiding unnecessary loss, you're watching something deeper than market timing. You're watching trust degrade, because no one goes to that effort unless they believe the rules are tightening. But here's why that detail changes everything. When governments get desperate, they don't only raise rates, they widen the net. They look for transactions they can skim, and bullion becomes an obvious target. Portable, valuable, and hard to control once it leaves the system. That's why jurisdictional arbitrage isn't a niche trick anymore. It's defensive strategy. So here are the three futures already forming. In the melt-up scenario, silver goes parabolic. Momentum, scarcity, and fear all fuse, and the price runs faster than logic can keep up. In the structural grind scenario, the market consolidates above triple digits, building a high floor, while volatility shakes out weak hands. And in the worst-case scenario, the infrastructure breaks, not the price. Spot stays high, but selling becomes harder. Spreads widen, and secondary silver turns into a liquidity trap. The deep lesson is simple. The price isn't the only risk. Access is, liquidity is. If you want to stay ahead of this cycle, follow and subscribe, because the next phase won't reward people who react. It will reward people who are positioned before the shock arrives.